Economic fair pay principle. Most of us want to be fairly compensated for the work we do. Let's look at a company with only an owner and no other employees. The owner can pay whatever he or she wants to himself, even if it results in a loss. However, if the company never shows a profit, it is not likely to exist for very long. For this analysis, we assume business owners who want to run viable businesses over a lifetime. Most, but not all, profit-making companies sell a product or service. Wall Streeters might make money through gains on stocks and bonds. No matter how money flows into a company, good owners will pay themselves as much as they can based on the generated profit before taxes. When an owner is paid this way, their compensation is in compliance with the economic fair pay principle. In economics, the optimum price-quantity relationship is found by graphing the demand and a supply curve based on real economic data. The point of intersection of the two curves shows the optimal price and quantity for that item. The items in question are for almost anything. Some believe workers are a commodity and their compensation should be based on the supply of and demand for workers. Our project and most economists consider workers people, not commodities. Both views have the same problem. When the economy is poor, the semi-skilled and skilled experience fewer job losses and smaller pay cuts than the unskilled. When times are good, the semi-skilled and skilled experience bigger and quicker pay raises than unskilled workers. Economists often use the example of an entity producing a hypothetical product. They take it to the marketplace and it is worth what someone will pay for it. If they lost money, they will decide if they want to build another one. Possible actions might be to reduce the cost of production by mass producing it. Or they might believe adding features would make it profitable. In other words, their decisions are based on improving profitability. If no profits are possible, they will shut down. If the entity made a profit in the marketplace, they will decide if it was enough to continue production. Even though this example may not be called the economic fair pay principle, it truly is. Pay for the producer over the long run is only possible if the units can be sold at a profit, and the size of the profit determines the magnitude of the compensation. In a one-man operation, that man determines what part of any profit before taxes should be taken by himself as compensation. But as soon as the owner adds a worker, complexity follows. Let's take a hypothetical case to illustrate the fair pay principle. Let's say an owner made $110,000 in profit before tax the previous year and paid himself $100,000, leaving $10,000 as the final profit before tax pool. Let's say he paid 20% in tax. So he is left with $10,000 minus $2,000 equals $8,000. So his profit after tax is shown as $8,000 and cash on his balance sheet increased by $8,000. He believes if he does the same work as before and hires a new worker, another $80,000 in profit before taxes would be made. How much of that profit before tax should the worker and owner be paid? The best answer for owner and worker is each total compensation should be directly proportional to each of their impacts on profit before tax. First, we need to discuss some issues. Dividends are paid from assets left after taxes have been paid. So if we want to pay dividends, we must account for that by not paying out the entire profit before tax pool. A business might want to expand without borrowing. This means the entire profit before tax pool cannot be paid out to the owner and worker. The company must pay tax on the profit before tax and then can use all or part of the profit after taxes to expand. The owner takes on the risk of business, so a fair percentage of the profit before tax pool must be allocated for this. Some believe this should be about 15% after tax. For an LLC, multiply the profit before tax by 0.15 and pay it to the owner. Pay out the rest in direct proportion to their impact on the profit before tax pool. Note that if the owner also worked, he would get an owner's share plus his work share. For a corporation paying an effective tax rate of 10% on profit before taxes, follow these steps. Subtract the tax rate of 10% from 100%, giving 90%. Then divide the 15% desired profit after tax return by 90%, giving 16.66%. Then multiply the profit before tax pool by 16.66% and subtract this amount from the profit before tax pool and pay out the rest of the profit before tax pool in direct proportion to their impact on the profit before tax pool. Note that if the owner also worked, he would get his work share. Few people or businesses want to pay income tax. For businesses with no plan to pay dividends, no plan to expand or replace assets, paying out the entire profit before tax pool to compensate the owner and worker means no income tax would be paid by the company. In our example, the owner put $110,000 in the profit before tax pool and the worker added $80,000. There is no dividend to be paid and no plan to buy more assets. So the entire profit before tax pool could be paid out, but with a 15% additional share allocated to the owner. In our example, the profit before tax pool is $110,000 from owner's work and $80,000 from the worker, or $190,000 total. First, 15% of $190,000 is $28,500 for the owner's share, leaving $161,500 in the profit before tax pool. The owner's work share is $110,000 divided by $190,000 times $161,500 equaling $93,500, and the worker share is $80,000 divided by $190,000 times $161,500 equaling $68,000. This is total compensation, not take-home pay. Things like Social Security, income tax deductions, etc. will be deducted. Now say the business wants to replace an asset worth $0 with a new one costing $5,000 without borrowing. Assume a 20% tax rate. We need $5,000 as profit after tax. Our equation is profit before taxes minus the quantity profit before taxes times 0.20 equal $5,000. Solving for the profit before tax, we get $6,250. Checking. We take $6,250 times 0.20 and it equals $1,250 of tax. Then $6,250 minus $1,250 is $5,000. It is correct. What should be fair pay for worker and owner? The owner still added $110,000 to the profit before tax pool and the worker $80,000 for $190,000. But now we need $6,250 profit before tax after paying out compensation. The profit before tax pool available for compensation would be $190,000 minus $6,250 or $183,750. Now the owner's share becomes 15% of $183,750 or $27,562.50, leaving $156,187.50 in the profit before tax pool. The owner's work share is 110,000 divided by 190,000 times $156,187.50 equaling $90,424.34, and the worker's share is 80,000 divided by 190,000 times $156,187.50 equaling $65,763.16. This is total compensation, not take-home pay. Things like Social Security, income tax deductions, etc. will be deducted. We justify an owner's share because the owner takes on the risks of business and invested in assets that make the business possible. Our fair pay model should be used by businesses of all types. Look at the UAW union. Every 3 or 4 years they fight over wages, benefits, etc. The compensation package is usually the major issue. They come to an agreement and the compensation is written as a specific amount. When times are good, workers are undercompensated, and in bad times, overcompensated. Our model always results in fair compensation. In our model, both management and labor have strong incentives to do the best they can all the time, since their pay is linked to profits. If the CEO wants more money, the CEO needs to earn it by making better decisions. All will share in the good times, and all will be compensated less in the downturns, but all will be paid fairly always. Corporations file results with the Securities and Exchange Commission every 13 weeks. We believe everyone, including the top dogs, should work for little pay during this time. The profit before tax pool will be adjusted by determining how much should be left for taxation, expansion, etc. Once determined, the profit before tax pool available for bonuses can be calculated and paid as shown in our example. If all businesses used our fair pay model, the idea of a government-dictated minimum wage standard would not be necessary. Since no one is using this model, a minimum wage standard is necessary. Do you want paid less than you earn and deserve? Many may be okay with more, but few want less. Let's make fair pay for all mandatory. If you are not a skilled worker, it is highly probable you have been undercompensated for your work. In some cases, it is likely you have been undercompensated by tens of thousands of dollars over a 30 or 40-year work life. This hurts both you and your family. If it has happened to you, it is unfair, it is disgusting, it is immoral, but it is legal, and it needs to be fixed. Even skilled workers have been hurt, but likely much less than the unskilled. The choices are clear. Don't join the CARA project. Don't work to get the CARA project implemented. Don't support the CARA project, and you will likely continue to lose many dollars due to being undercompensated. Do nothing and make it easier for the overcompensated to continue to be so at your expense. Or you could become part of the solution by joining, working for, and supporting the CARA project. Please view our fair taxation, our pension, and/or our project plan summary videos. Then you will know our project is the best plan for our economic health and vitality.